Every few years, the pattern repeats. Businesses expand, spending spikes, jobs are easy to find. The economy feels like an engine running perfectly at top speed. And then, suddenly, the engine breaks. Companies issue mass layoffs. Consumer spending dries up. The entire market crashes. Everyone always asks what went wrong. Why does this exact cycle of rapid growth and sudden failure interrupt our lives? The truth is, recessions are not accidents. They are not unpredictable errors. They are built into the design of the system. Let's model the economy. 100 people, 10 businesses, 1 bank. Money looping between them is the economy. Fast money forces businesses to expand and hire. A recession is simply this money decelerating. It stops moving, dictating fewer sales and jobs. Understanding exactly what speeds this flow up and what violently slows it down explains why economic crashes are guaranteed. The cycle always begins with high confidence. The system is healthy, so the central bank feels secure and starts handing out loans easily. The townspeople take this borrowed money and buy expensive items they couldn't afford on cash alone, like cars and real estate. Overall demand spikes overnight. Businesses see this massive wave of demand, so they expand. They hire aggressively, produce more goods, and push daily spending from 100 rupees to 200, doubling the speed of the system. But here is the structural flaw. This new activity isn't coming from real income. It is driven entirely by debt. A boom built on borrowed cash perfectly mimics actual wealth. Everything looks prosperous on the surface, while the town quietly accumulates a massive tower of risk. Because easy loans are available to everyone, demand continues to surge, and as a result, the prices of everyday goods and assets begin to skyrocket. Consumer incomes haven't increased fast enough to afford these new prices. To maintain their living standard, townspeople borrow even larger sums, creating a dangerous feedback loop. This chart tracks exactly how prices detach from reality. The flat blue line is the actual underlying value of a house based on steady income. The red line curving violently upward is the market price. Buyers just have access to massive amounts of cheap credit. When prices aggressively detach from underlying support, you have a bubble. Bubbles make the entire town incredibly fragile. They exist purely on the assumption that endless credit will fuel endless consumer confidence. Then a minor localized shift breaks the tension. Interest rates inch up, or a small group of people fail to repay their loans. The bank gets spooked by defaults. To protect its reserves, it immediately stops issuing new loans. The cheap debt that fueled the town's hypergrowth instantly vanishes. With lending frozen, consumers lose extra buying power and stop spending. Business revenues crater, forcing mass layoffs. Panic spreads. Even those with healthy finances freeze their spending out of fear. The engine completely stalls. The system did not collapse because of the initial unpaid loan. It collapsed because the web of confidence evaporated. The economy is now locked in a stalemate. Fear keeps everyone from spending, and a lack of spending keeps businesses from hiring. Without an external force, the gridlock remains. So the government and central banks step in. They slash interest rates and inject massive amounts of fresh capital directly into the system. The sudden return of cheap debt slowly convinces the townspeople to borrow and spend. As sales slowly take up, businesses begin to hire again. The gears are forced to turn. The exact same mechanism that inflated the disastrous bubble, cheap debt, is the only tool used to restart the engine. This chart traces the full, inescapable loop. Easy money drives growth. Growth creates overconfidence. Overconfidence inflates bubbles. The bubbles collapse, and the intervention resets the board. This exact mechanism governs our 100-person town, but it also governs global supply chains, massive stock exchanges, and national economies. A crash is not bad luck. Endless growth built on borrowed money cannot last. Eventually, reality catches up, and the crash is the system violently purging that unsustainable debt. Boom, bubble, break, repeat. Recessions do not destroy the economic engine. They hit the reset button so the cycle can start over tomorrow.